Hey everyone, hope you're all doing well. Welcome to the video. So we're going to go through supply and demand theory, exactly what it is, because our strategy it revolves around supply and demand, order blocks, etc. So it's definitely important to know exactly what it is. We're also getting into consolidation and expansion. We'll start with that and then we'll go from there. So if we start on the left here, the markets either do one of two things. So price either consolidates or expands. Now, if you come from previous strategies, you may know this as impulse and correction. So the correction would be the consolidation phase, and the impulsive phase is known as the expansion. So starting on consolidation, this is a period in a market where price is moving calm, which moves in a range known as the dealing range. Now we will be able to identify a clear high and low to this range. So you've probably heard of the term range bound or ranging or consolidating. This means that price is typically staying in one area and just moving sideways rather than moving up or down. So again, a range bound market means that price is typically staying in one area with sideways price action rather than in one direction, up or down. Now this range can be tight, meaning a spread of only a few pounds or dollars, or the range can be loose, meaning a spread of hundreds of thousands of pounds or dollars, from that range high to the range low. Now this will partly come down to the time frame that someone is implementing. Now usually the lower the time frame, the tighter the spread, meaning it can be a few pounds or dollars. And the higher the time frame, the looser the spread, meaning the more money basically. So it could be thousands, hundreds of thousands. But again, consolidation is a state in the market where price is moving calm and ranging, or range bound is just sideways price action. And if we look at this diagram down here, you can see this would be our consolidation phase where price is moving sideways. So you can see we've gone up, down, up, down. Sideways price, we aren't moving, in one direction. So moving into expansion, this is a period in the market where price is moving aggressively in one direction or the other. So we will see an impulsive move to the upside or downside, where price will give us large candle bodies or wicks. As you can see here, we had a large impulsive move up. This is expansion. So we will see large candles or large wicks in one direction over the other. So that's basically consolidation and expansion / impulse and correction. Now what we're going to do is get into supply and demand, starting on demand zones. Okay, so demand zones, this is an area of consolidation that comes before an impulsive move towards the upside, i.e. bullish price action. So this is our demand zone. Price impulsively moves towards the upside, as you can see. So this is our demand. This consolidation phase is our demand. So demand zone is sometimes referred to as bullish consolidation block. So what we will usually see is a range bound market followed by a bullish expansion. So exactly this, range bound market / consolidation followed by an impulsive move, which is then creating this bullish consolidation block, and this is the expansion up. Now, this demand zone can act as support when price action drops down into them. So once we push up here, this could be known as support, but we know it as, order blocks or consolidation, demand zones. Price can fall back into them to enter longs and or close short positions. So again, demand zones can act as support when price action drops down into them from the top side. Demand zones are used to enter longs, so once price comes back into them, we can enter longs and or close short positions. Okay. So how to mark off demand zones? Well, we take the low of the range and the highest candle body, or we can take the actual trading range as a whole. So this would be our range. We can take this, but we would have, order blocks within this range as we get into. But this is just the theory. So consolidation, range bound, expansion up. This can act as support as our demand zone for price to come back into, so we can enter longs and or close, short positions. So supply and demand, supply zones. Okay, this is an area of consolidation that comes before an impulsive move towards the downside, as you can see from this example, which would be bearish price action. So this is the bearish price action we would see, which breaks out of this consolidation phase. A supply zone is sometimes referred to as a bearish consolidation block. So what we will usually see is a range bound market followed by a bearish expansion. Range bound market, bearish expansion down, breaking out of this consolidation. Now, supply zones can act as resistance when price action pushes up into them from the downside. So once we broke here, price pushed back up into the supply zone, and this can be used to enter shorts and or close long positions. So if we're looking down here, we may have something to the left, i.e. a demand zone that we can trade long back into, so we can target, the supply zone, and then look for shorts from this area. So how to mark off supply zones? We take the high of the range, so the highest point, which would be, the wick, and the lowest candle body, which would be the lowest body, so not the wicks, the actual body, the lowest part of that range. But what I like to do is just take that trading range as a whole, so the high and the low. But in some examples, if we've got a huge wick, then we can use our initiative and take the candle body and just look to see where the actual range is, and not account for that wick. So now we've got an example of a demand zone where we've got an expansion up, which came after a consolidation / a range bound market, and price then came back into it. So if we just take a look at this example, we had this range here. So this is our consolidation range, which would be more visible on a lower time frame because we have 4 candles here. So I'll just zoom in. We have this one, 1, 2, 3, and 4, which are moving sideways, consolidating, and the next candle is where the expansion happened, which also broke structure. So we pushed up, forming a higher high and a higher low, and you can see we then start to form these higher highs and higher lows. But if we take a look at this, so these are the rules up here. So the demand zone, the area of consolidation that comes before an impulsive move towards the upside. So this is that consolidation before the impulsive move to the upside, which also broke structure, this high here. So number 2, we can take the low of the range and the highest candle body, or we can take the range price is in as a whole. But if we look at taking the low of the range and the highest candle body, this blue candle here would be the low. Now why wouldn't it be this wick here? Well, this is the candle that actually showed the expansion. This is the impulsive candle. So this is not the range. This is the candle that broke out of that range. So this would be the low. We take the lowest point, which is the wick, and the highest point we can look at would be, let me just get that right. So the low, the wick, and the highest candle body. So it's here. But as we also put here, or we can take the trading range as a whole, which is what I do personally. So for me it would be the highest point, and then the wick, the lowest point. And again, not taking into consideration this wick, because this is the candle that actually broke with that expansion, okay, impulsive move. So this is our range 3. Demand zone is created once the expansion takes place, is what that's meant to say. Okay, so you can see expansion takes place, break structure. This is the range, this is our demand. Price action will fall into demand from the top side. Okay, so this is the top side. We fall back into the demand. 4 demand zones can be used to enter longs, as we learned in a previous video. We can also use them to close down any short positions that we may have running, as it's possible that we can see a reaction from a demand. So if we are in sales from here, we want to be thinking about, setting targets or closing down manually once we can look at how price reacts to the demand level, because it's likely we can see that reaction and then for the push to the upside, which is what we got here. So how could we go about entering this trade? Well, we can set our entry a limit order, and the limit order is valid as soon as we break here. So as soon as we see this expansion of price that comes after the consolidation range bound market, we can set our limit order at the top of the consolidation slash order block range in market. So we can set our entry at the top. Now you can see here we had a wick back down, but we wouldn't have been tapped into the market because price then pushed up, made a new higher high. Now this wick down was just to try and rebalance any imbalance that was left here, but we also left imbalance here. And don't worry, we'll get into imbalances in a later video, but that's what this was. We pushed up, higher high, and then we come back down, breaking these lows, and we would have been triggered into the trade. Now, what about stop losses? Well, we can place our stop loss either at the low of the trading range, or we can account for any wicks that we may have. So we've got this wick here, so we can put our stop loss at that wick or just below it, because price can come down to mitigate the entire sort of trading range and any imbalance or inefficiency that was left on this impulsive move before then continuing. So if we put our stop loss directly at this sort of block or trading range, then it's likely we can be tapped out with a wick before price continues. So giving yourself that 1 to 2 pip sort of buffer, or accounting for the wick, you know, it's a lot safer to do so. But that's the example of a demand where we're looking at expansion and consolidation and how we can look to enter it. But let's now get into a example of supply and a sell example. Okay, so now we've got a example of a supply. Now we are on GBP USD on the hourly time frame. So let's get into this example. So what we can see is price was putting in these high highs and these higher lows. So higher high, higher high, higher low, higher low, higher high, higher low, higher high. Okay. Corrective price action, which is efficient. So all of these moves are, you know, we're making highs, retracing, mitigating, making highs, retracing, mitigating, and then continuing. So now when we look at here, you can see we had an impulsive move to the downside, which is the expansion. You can see it's aggressive. And if you compare this move here to this entire move, you can see it's the same length, and you can see the difference in the candle size. We do have some candles within this, like these two here, but 80% of this move here is corrective and this is impulsive. Okay, so this is the expansion phase. We also broke structure to the downside, so we broke structure here and here. So let's look at our rules. So number one, the area of consolidation that comes before an impulsive move towards the downside, which is bearish price action. So this is that bearish price action. Where's the range that come before this? Well, this is here. So price made this higher high here, above this high. We then had a higher low. Price then wicked that high, but it failed to break above and put in that new high. And instead we got two wicks and we sort of, you know, we're losing that momentum. You can see prices failing to continue going up. We get a bit of a range bound market, and then we initiate out. So number two, we take the high of the range and the lowest candle body, or we can take that trading range as a whole. Okay, so if I just zoom in, where's the higher? Well, where does the range start? Well, this is pushing up. This move here is the move that broke this high. Okay, so that's not a range really. It's corrective, but it's not a range. This is more of a range. And I would be looking at, you know, from, you could say from here, from this candle or this bearish candle, all the way until, you know, we initiate out with the expansion. So we take the high of the range. As you can see, I put on the high. This is the highest point, which is this wick, and the lowest body. So let me just put on the lowest body, as it's not on there just yet. Oh, hold on. Let me just move that to the back. Okay, so where's the lowest body? Well, you could say this candle, but this is when momentum started to come into the market and then did come in. So this candle here is the same as these candles. So I wouldn't be looking at that. I'll be looking at the next one, which is here. So this is the lowest candle body. These two candles, so this grey one and the blue one, they're both the same, so we can use both of these. So we've got the lowest candle body, as the lower the range and the higher of the range at the wicks. But as I said already, I take the overall range, the low to the high. So I'm going to put it back to where I have it here. I will take this low here and the high, because we then initiate out with the expansion, which come after the consolidation range bound market. So number 3, supply zone is created once the expansion forms. So we've gathered that the expansion is here. This then confirms this as our supply and our consolidation / range bound market. Price pushed in, price action will fall into the supply, or price action will push up into the supply from the downside. So you can see we push back up, and this is also, this move here is also rebalancing inefficiency, as I'm marking on now. Any liquidity or imbalance that was left on this large move is being rebalanced before large banks are continuing price down. Okay, so number 4, okay, so I need to change this. That says demand, supply, and this bit here. So supply zones can be used to enter shorts. Supply zones can be used to enter shorts. We could also use them to close down any long positions. Long, not short. Okay, so again, just if you're a bit confused because I didn't update this, supply zones can be used to enter shorts as we push back into it. We can also use them to close down any of our long positions. Now, if I just go through something very key here, we push down, which is expansion, that came after consolidation. But what do we tap into here? Well, I've got it marked on. So if we look left, what is this? Well, it's a demand zone, right? Because we've expanded up from a range. Okay. So if once we see price come down, we can look for longs from here, because we've tapped into a demand which also left imbalance. And notice how price has respected this area. Even if I drag this out, now I've got this line on because it's marking the halfway point of the demand, or this order block. This is more so an order block, this candle here. This line is the equilibrium point of the order block. So that means it's the halfway point. You can see price taps in. Now the equilibrium gets respected a lot with these sort of supply and demand levels. We tap in, we push off. So if we was looking for a long here, let's just say we looking to get in long here. Obviously, I'm not going down on lower time frames. I'm just showing you the concepts of supply and demand. So our stop loss would be just below, and we enter the top. Now that we know we have this supply up here, we can target it as it says here. Okay, we can target sort of the beginning or the base of the supply, and you can see how perfectly it played out. Now this is at 4.3R with a 26 pip stop loss. Now on lower time frames we can get in with a much tighter stop loss than this, but this is just to show the concepts. So then we tap in to the supply, and then you can see we push off. Now we come into this demand again, right here. Let me just delete this off. And you can see how price has kept to this demand, we've respected it. We actually mitigate more than 50% here, so we actually mitigate around 90% before we then continue. So I wouldn't be surprised if we then push up a little bit more and then we come down, because this has been mitigated now. So we can actually come down lower and past this order block or demand level. But if we just focus back on the supply, you can see we come out, expansion, this comes after the consolidation. We come back up to rebalance, we tap in, so we can set our entry at the low of the range, with our stop loss again just above 1 to 2 pips above the high of the range and the supply zone, with the expectation that we're going to tap in, mitigate. You know, we could just tap in by a couple pips, or we could push up higher right to the top of it and then continue from here. In this example, you can see we tap in by a couple pips and then we respect the supply zone, and price is now rebalanced, so we can continue down and looking for lower lows, but also understanding what we have here. Okay, this is why price is respecting this area. You can see we tap in once, twice, 3 times, mitigate 90%, tap in again, and now it looks like we're pushing off. This could push up to another sort of supply or a bearish order block up here, because this is the last up move before the down move, broke structure. But that's all I wanted to cover really on supply and demand. So what we're going to get into next is going to be order blocks and how we can go about trading them, and then refining them down on lower time frames.